All right, before we jump in, just a usual heads up. This is purely for educational purposes and is absolutely not financial advice. All right, welcome everyone. It's February 4th, and wow, the market pressure is really not letting up. Today, we're going to take a really honest look at this extended correction and what it means for the fund. So let's just dive right in. Okay, so here's the plan. We'll start with the tough news, the new low. Then we'll put the yield engine under the microscope to see how it's holding up. After that, we'll look at some surprising accumulation numbers, zoom out for the bigger picture, and wrap it all up with our final verdict. All right, first up, and look, there's just no way to sugarcoat this. Today's numbers are tough. We've officially broken below that crash low we saw back on February 1st. The fund is now down a full 33% from its all-time high, which was set back on January 14th. I mean, that's the most significant drawdown we've tacked so far, period. And this table here really tells the story, doesn't it? That little bounce we saw yesterday, well, it just didn't hold. The market pushed us down even further, and we've landed at a new low of just under $1.33 million. So what drove this? Well, it was a pretty significant one-day drop of over 10% in the fund's value. And this is really tracking the broader crypto market. You know, we saw ETH fall another 6% overnight, landing around 2152. Okay, so that's the bad news. The market is in turmoil. And this brings us to probably the most important question we can ask on a day like today. Is the core protocol, is the thing itself still working under all this extreme stress? Let's take a look under the hood. Yeah, this is where we need to look past the scary asset price and really dig into the protocol's mechanics. You know, the system that actually generates the revenue. The big question is the engine still running? And the answer is yes, a resounding yes. Despite the market absolutely crashing and the fund hitting new lows, the yield engine still churned out nearly $18,000 in the last 24 hours. Think about that. And this chart just brilliantly illustrates the engine's consistency. I mean, sure, it's down a little bit from yesterday's peak, but look at it compared to the crash day on February 1st. The yield generation is still substantial. It's just incredibly consistent, all things considered. So what's the fuel for this engine? Well, it's trading volume, right? And that volume is holding up. It's healthy at $13.7 million, which is right smack in the normal range we've been seeing. So the issue right now isn't a lack of activity in the protocol, it's simply the declining price of the underlying assets. Okay, so now let's shift gears a bit. Let's look at how the bond market is reacting to these prices, because this is really the other side of the story. This is the opportunity inside all this pain. And here's where that opportunity really kicks in. Bond prices, they are now 29% cheaper than they were just 2 weeks ago on January 28th. That is a huge discount. This slide really breaks down what that discount means in the real world. You know, $10,000 today buys you 40% more bonds, more ownership in the protocol's future yield than that exact same amount of money would have just 2 weeks ago. That's a massive difference. And it's clear people are taking advantage of this. Check this out. Over 230 new bonds were minted just yesterday, right in the middle of this market crash. That kind of action, that speaks to conviction, not panic. Okay, now to really get a handle on where we are today, it's so important to remember where we've been. So let's zoom out and look at the entire journey so far. You know, this 57-day journey shows this really clear cycle of these powerful rallies followed by these sharp, painful corrections. Today's new low, it's just part of the 7th distinct phase we've been tracking since we started, an extended correction. So when you put it all together, over this entire really volatile 57-day period, the fund is down a net 18.3%. All right, let's bring it all home. Let's put it all together for our final verdict on the protocol's health as of today, February 4th. Okay, the challenges are obvious and they are significant. We're at a new low. We're down 33% from the high, and the macro environment is just punishing right now. But, and this is a big but, the protocol's core functions, they're all still working exactly as they're designed to. The yield engine is running, new bonds are being minted, volume is healthy, and the wallet is still accumulating ETH, with over 94% of the funds deployed. Look, this is probably the hardest day to be a bondholder since we started tracking this. We're at new lows. We're down 33% from the all-time high. That little bounce from yesterday, it didn't hold. And if you're feeling anxious, that is completely valid. This is what these corrections feel like. But I want you to look at the numbers beneath the headline. $17,800 in yield generated today. 237 new bonds minted. Healthy volume at 13.7 million. The yield engine is still running. For those with long-time horizons, this is exactly what discounted accumulation looks like. For everyone else, the yield engine just keeps going one day at a time.
We're going to get through this correction together. We'll keep tracking it closely, day by day. Thanks for watching, and as always, please remember to do your own research.